Hello, hello, and welcome on Wednesday, September 10th. We are getting rolling here with our third installment of the Make Taxes Fair weekly tax strategy webinar. I'll let folks kind of filter in, and I'm going to launch my slideshow. We have had some issues in the past with the chat. So I apologize. I think we have those ironed out. We'll see. So if you could put in the chat, if you are able to, say hi and where you're calling in from. If the chat is not working for you, please go to Q&A and just put a Q&A in there. Let me know, hey, chat is not working. Technology, when it works, is a beautiful thing. When it doesn't, you end up pulling your hair out and going bald. So, let's see if we can see in the chat. Anybody drop anything in there successfully? If not, put in the Q&A and let me know if the chat is disabled. It will play it again one more time and see if we can make that happen. Mateo, you're in here. If you don't mind, Mateo is part of my team. If you don't mind, just put in the Q&A if the chat is disabled, let me know that. So if you go along and if the chat is not working, I apologize. We looks like that's the case. Good times. Technology when it works. Yep. I'm getting an answer that says yes, it is disabled. Apologies, folks. We're probably gonna switch platforms next week. But we'll update you. Try out a temporary platform next week and test drive that to see if that gets better results. But sorry about that with the chat, but let's roll forward. So I want to welcome you. It's 10:01. We're going to get started here. You should be able to see my screen, and this is the again, third installment of our weekly tax strategy webinar presentation. So today we're going to be talking about tax deduction, topic of accountable plan and fringe benefits. And so the agenda, or what we're going to be talking about in order, is introducing the accountable plan and fringe benefits. We're talking about who these things are for, strategic use of accountable plan and fringe benefits, and pitfalls to avoid. So big thank you for being here. Appreciate you spending some time with us. Your time is incredibly valuable, and we're really excited to drop some amazing knowledge on you. There's not a lot of people that are aware of accountable plans. This is a topic that and it leads into fringe benefits. So it's a topic that doesn't get enough attention, in my humble opinion. So thanks for being here. If I had a magic wand that I could wave, right, to translate knowledge that we're going to share with you into implementation, I would absolutely wave that magic wand, but I don't, right? We don't live in a Harry Potter world. So what we've done is we've created a workbook that gives you the ability to really help save you time. It's not magic, but in the sense it is, because it helps save you time and helps you take specific next steps on implementing knowledge. So the question is, when you registered for the workshop, did you grab the workbook? And the answer I know is no, because we get confirmation when people register for that. So the workshop today and every week is totally free. And every week we're going to make an offer to you to say, hey, for a buck, for $1, we're going to give you the workbook for each week's webinar, right? That tracks along with the topic. Plus, if you're new to this and just getting the workbook for the first time, we're going to give you a free trial to our VIP tax strategy community. I am going to put, and again, apologies for the chat not working. I am going to put in the chat though, you should be able to see that link. It's content, the https:// content dot make taxes fair. And that is where you will go if you're interested in grabbing this workbook. So while you do that, or if you decide to do that, why is the VIP community, right, important? inside of the community, if you're a member of our VIP community, that's where you're going to find this recording for the playback along with the workbook. So if you jump in and grab the workbook today, that should be there and live, but that's where you'll grab the workbook. And again, I know for a fact that some folks, which is fine if you jump in, you don't grab the workbook or the VIP community. But our motto is we say, friends don't let friends overpay the government, right? And so that's why we share these resources and are putting this information out there. So the workbook and the free trial to the VIP community. And while you grab that or take a peek at that, I do want to share something with you. One thing, real quick. The replay for this webinar is also posted. We post in the free community as well. So if you go to maketaxesfair.com forward slash community, that's where our free community, and that's where you'll find the webinar, right? So most people are, they jump into these webinars because they feel like they're paying way too much in taxes. In fact, I love paying taxes, said no busy business owner ever, right? But at tax time, it feels like paying your taxes feels like you barely survived 12 rounds in the boxing ring with this guy. And entrepreneurship already feels like you're getting beat up, daily. In fact, I hate the term small business because there's absolutely nothing small about being in business. And taxes just add to those burdens that we carry as entrepreneurs. And the system, the IRS has designed a system of confusion, right? This is a visual representation of the IRS roadmap or the taxpayer roadmap. And I call baloney. I say, if that's a roadmap, where's the GPS, right? That looks more like a roadmap of confusion. And so it's a small wonder that the reaction of most business owners to their taxes is something like this, right? They stick their head in their sand. They say, hey, my CPA's got me. And the reality is this, that your CPA doesn't have you covered, sadly, because no disrespect to the profession, but most CPAs are what I would call happy historians. They're putting their heads down, working on putting the right numbers in the right boxes for tax reporting and compliance. But the result is that it's a very reactive approach that feels like you've gotten a total knockout at tax time, right? So navigating the maze to avoid feeling like you've got a total knockout at tax time is tricky. A lot of people ask friends, what are you doing to save money on taxes? There's a lot of people doing a lot of shady things, so be careful of that. Also searching Google, and that can be dangerous because I mean, I've searched Google and then I was looking for something around a political something, and it was popping up articles that were like 3, 4 years old. I was like, that's the results were showing up. Even the AI results were showing information that I was like, I know for a fact that's outdated information. So, doing internet searches can be sketchy, or even asking your CPA and not getting any real results. So, that changes today because we're going to dive into a strategy today to give you a complete solution with the workbook and everything that will help you implement. But first, who is this bald fella on the screen, right, talking to you? My name is Chris Middleton, husband and father, self-proclaimed goofball, nerd. Got me and my wife in Superman shirts, going to see the Superman movie, right? I've been a business owner since before 2006, but full time in 2006. I have an accounting degree. I'm a tax professional and a tax strategist. So we are Make Taxes Fair. We're a proactive tax firm that we do prepare taxes for folks, but we focus primarily on the strategy for entrepreneurs. Our name is our mission because we believe that Make Taxes Fair is what we should be doing. And at the end of the day, we want to help you make taxes fair. That's the goal. And the other piece of this is today, the strategy that we're going to be going through and working with you on, it's part of what we would call the Clear Edge framework, right? And the Clear Edge framework stands for this, each letter in the Clear Edge stands for a specific pillar of tax strategies. And today we're going to be focusing in on deduction optimization and helping you optimize your deductions. If you've never been given a framework like this by your accountant, I guarantee you you're overpaying in taxes, right? So if you got the workbook pulled up or diving into that, let's get going. So lock and load, eliminate distractions. We're going to lock in for the next 30 to 45 minutes and jam on accountable plans and fringe benefits. So, first thing is, what is an accountable plan, right? The accountable plan and fringe benefit. Well, in last week's webinar, we talked about S corporations and the tax savings that come from S corporations. And many of you business owners make that switch from, when it's the right time, and we talked about that in last week's webinar, the right time to make the switch from sole proprietor to a corporation. But when there's a shift that's made, great, you've made that shift in your legal structure, but many people fail to switch how they handle certain expenses, right? Um, if it ain't broke, don't fix it. So if that's what you've been doing for so long, it's why change, right? But when you upgrade to a corporation, there's a shift that needs to happen, and this is where many S corporation owners miss huge tax savings because they fail to fully leverage their S corp, right? So I'm going to give you an example here. We're going to talk about Jeff, right? Jeff, handsome fella, he was a consultant, right? He worked with auto dealerships and worked with, you know, um, businesses in the automobile industry, right? So he had made the switch. He'd formed a corporation. Actually, he formed an LLC and made the S election. We talked about that last week. How you form an LLC or C corp and then make the S election. And his expenses, as you know, a consultant, he had a lot of driving. He was driving around town, driving across the state to visit dealerships and help them in kind of the sales training mode. He had a home office, right? He worked primarily from home, and he wasn't really taking advantage of any employee benefits. And he had his phone expenses, right? But he was like, "Hey, I want to take advantage of some employee benefits." Well, when he switched it to the S corp, right, he stuck with his old expense system. And as a sole proprietor, right, you're allowed to write things off there. You can commingle your personal and business, right? There's no requirement to keep things separate. But he was like, well, I'm paying my mortgage out of my personal account, not my business account, because it's my home. And, so he didn't really have a way to capture his home office, or he didn't know how to capture his home office as an example. So we told him and helped him and said, hey, look, corporation owners need to take an extra step for some expenses where there's personal carryover or crossover, right? If there's personal crossover, you don't want to pay for that bill out of your personal account or the business account, because at that juncture you've pierced the corporate veil. You've said, hey, I'm going to pay for this personal element or personal thing out of my business account, and that's going to pierce the corporate veil and eliminate any protections that you may have thought you had. So the people are aware of that and don't want to do that. So we helped him when we set up an accountable plan. So we helped him set up an accountable plan and started to capture the deductions that he had just flat out been missing. So what is an accountable plan? IRS publication 463 gives us the definition. It's a reimbursement arrangement between the employer and employee requiring a business purpose, right? So if you're reimbursing for something, there needs to be a business purpose, timely documentation, and a return of excess amounts. Okay, so what does that mean? Let me show you how this works. Well, without an accountable plan, if somebody if somebody did not have an accountable plan and they were getting reimbursed or the company was reimbursing, we run the risk where those reimbursements need to be added to employee wages and then pay the payroll taxes on them. But with an accountable plan, we can say, hey, the company needs to reimburse, we need to give the money back, money that they spent on the company's behalf, and that reimbursement is exempt from payroll taxes. And then the employer, the company, gets to deduct that expense without payroll taxes, right? So it ends up being a win-win. Well, in order to capture that, you need to implement or adopt an accountable plan. This is a screenshot of an accountable plan sample. In the workbook, we have a accountable plan template that you can swipe. It's a sample accountable plan. We're not saying that is the one that you use. In fact, it says sample at the top, right? So it always cracks me up when I come across business owners and they're, oh, I have an accountable plan, and they got a template somewhere that says template and they didn't update it. So at the end of the day, we need to adopt an accountable plan. Well, who should be adopting an accountable plan? So I'm sorry to break your heart, but if you're not a corporation, LLC or a C corp, a multi-member LLC or a C corp or an LLC or C corp that's made the S election, then this is not for you. So if you are an LLC with multiple members, a C corp or an S corp, you're in luck. At the end of the day, the accountable plan is for you. But you have to be aware that if you are offering benefits under the accountable plan, that you can't discriminate. So you can't say, hey, I'm going to just offer these benefits to me, myself, and I, those three key employees, right? If you have employees or people that are part of your team, you need to offer those benefits to all. So at this juncture in the workbook, that's where you would pause and say, okay, is an accountable plan the right fit, right? Is that the right fit for you in your bit for your business, right? Is that going to be something that you need for your business? So that's going to be a kind of a pause and engage as you're downloading that workbook and working through that. There will be an exercise to say, is the accountable plan the right fit? And what should you be doing with that? So if you do have a corporation and you're running an accountable plan, there are requirements for compliance, right? Again, to avoid the commingling of funds, we have to keep things clean. And so there's this relationship between the employee and the employer. And to be clear, if you are an S corporation or S corporation owner, and you can be the only owner employee, it can be a solo operation, you are still the employee of your corporation. And so at this point, the employee, this is the requirement that folks are like, man, this is a pain in the butt. But if I have, for example, a home office, then I'm going to measure out the home office and say, hey, my square footage, I did this with somebody the other day. 19.83% of their square footage of their home was exclusively dedicated to business, almost 20%. And you'll notice I said 19.83%. That's specific, very specific on the square footage because we don't want to round up and say, oh, 20%, right? We want to keep it specific. So now I helped Jay, was his name. We walked through and said, okay, his utility bills, his home internet, the repairs on his lawn maintenance and garbage, water, sewage, a portion of his mortgage. In his case, he paid rent, so a portion of his rent. So we were able to capture for him almost it was like $483 for that last month, right? So we took those bills, added up his all of his bills, and then took the 19.83%. And at that juncture, we took those receipts and we filled out an expense report and submitted that to his employer. Well, he is his own employer. It's his company, right? So now his employer, so he turned around and said, "Hey Jay, we created that expense report. That's 483 bucks this month. Do you confirm that?" I'm joking here, but we went through the exercise, and he's like, "Yeah, that's gonna be rubber stamped. That's all legitimate and approved." So we filled out that expense report, and then he's going to now reimburse himself and take effectively almost $483 out of his business tax free. Not bad. So that's how we do the mechanics of that. And to stay compliant with this, you really do have to process the reimbursements within a reasonable time, right? So what does that mean? Reasonable time, you set parameters around with the employees and say, hey, look, reasonable time to provide the proof. You need to submit the documentation within 60 days or less from the end of the period, right? The reporting period. Optimally, you should be doing this every month, every 30 days, and doing a monthly expense report. The employer reasonable time can mean 120 days or less, basically 1 quarter, to reimburse that employee. So the IRS frowns on companies using their employees to float expenses, but basically we need to get those expenses reimbursed within a reasonable amount of time. So remember our buddy Jeff, right? The consultant? Well, because he's considered an employee under his own business, he must create an accountable plan that covers the expense reimbursement policy for his company, right? So Jeff, every month would submit in his case, we landed on 60 days, which is why that's in the example. He said if the least amount of time I have to spend on this, the better. I'm like, okay, fine. So he's okay with every 60 days creating that expense report and submitting it to the company. And then within the 120 days, he reimburses himself. In reality, he submits it and transfers the funds over and then books it in his bookkeeping, right? Takes that and splits it out between all the different categories. Now, Jeff, because his vehicle, right, was he uses his vehicle and he's driving around to different dealerships and driving to, across the state and sometimes out of state. His vehicle expenses were really high. And in the past, Jeff was just using his business card to pay for the gas, pay for the oil changes and everything. He was ended up shortchanging himself in the neighborhood of about $8,000 a year in deductions because the mileage rate, had he been reimbursing himself on a routine basis, the mileage rate, which is I think 71 cents a mile right now, really factors in gas, oil changes, all of that. So on top of that, we're able to he was paying for his gas, oil changes, everything with his personal money, but let's say his out-of-pocket costs for that month were like 350. Well, his expense reimbursement for his miles, the last month that I looked at it with him was almost $900. So he was actually coming out of pocket like $300, but he had a hybrid that he was driving around. But $350, I think, was his actual out of pocket. But the expense reimbursement with the mileage expense was actually giving him almost a $600 bump in money that he was able to pull out of his business tax free. That's pretty powerful. He's like, Chris, that covers half of my mortgage, right? That I just with that extra money, he was able to throw he had a really kind of a condo living in his home. He had a low mortgage, but he's like, I'm able to effectively double up on my mortgage payment that month because he was able to pull money out of his business tax free. Fairly powerful. His home office, same deal. We were able to measure out and say, hey, how much of his expenses were or of his home was business use. His was lower, it was like 11.32%, I think. So it was a lower amount, but we were able to reimburse him for home office. And then his phone, because his phone was kind of on a family plan, he was sharing it. He didn't want to put the entire phone plan on his business. So we were able to reimburse him for the phone expense. So all of this was tax deductible, and his reimbursements that we were able to get out of the company were all tax free. Fairly powerful, fairly powerful. So, fringe benefits, let's talk briefly about that. Fringe benefits are one of those things where we can go to IRS publication 15-B. A fringe benefit is a form of pay, includes property, right? If you were to give, buy somebody an employee a new phone, services, if you were to say, hey, we do childcare, that's your employee. Well, we can give you your kid can come to take childcare, get childcare for free, as an example of services. Cash or cash equivalent. So cash equivalent is gift card, check, that type of thing. So this is a form of pay in addition to the stated pay for the performance of services. So what that translates to in English is I work for you, I get paid by the hour. That's the stated pay for performance, right? If you're giving me a fringe benefit, it's a form of payment above and beyond my hourly wage that you're paying me. So fringe benefits are really powerful if you stop and think about that one member of your team, that one employee that you want to keep around. You're like, how would you keep them? Most of the time, folks say, hey, we're going to give them a raise, right? Or offer them some perks on the job. Raises are subject to payroll tax, but if the other perks that you do, the fringe benefits, those can be deductible without you and your employee incurring any payroll tax or income tax. So you got to be aware, not every perk you hand out is tax free. Not every fringe benefit is tax free. And if the IRS says, hey, this looks too much, if it looks or smells too much like overtime pay or wages that you're trying to disguise as fringe benefits, then you run the risk of having those be pulled out and taxed just like wages. So fringe benefits where there's a red flag or you need to avoid is cash or cash equivalent. There are limits every year of how much you can give an employee on gift cards or that type of thing. If you're paying for family vacation, like, hey, we're going to pay for your trip to Disneyland. Well, guess what? That should actually, I'm working with somebody right now where they get kind of bonus or spiffs. Like if they sell so much every month, their company that they're affiliated gives them like a reward. Hey, we're going to pay for, like right now they're competing for a trip to Thailand, I think, and it's worth like $5,000, right? So if they win that trip to Thailand, they're going to get a 1099 for that. That's taxable. That's a taxable perk or taxable bonus. Um, Commuting costs. So if you're covering commute right from not from home to workplace that's not tax deductible, normally those commuting costs should be a fringe benefit that's taxable. And then club membership, right? If I pay for a gym or a club, and to be clear, if a club, let's say a club membership, let's take that as an example. If that's $1,000 a year, or let's say 1,200 bucks, $100 a month, 1,200 bucks for the year, and I'm saying, hey, I'm going to pay for this and it's going to get added into your W-2 compensation. So as an employee, my only cost is my marginal tax rate plus Social Security and Medicare, my portion. So let's say on 1,200 bucks, I effectively am paying, say, 400 bucks. Like that's a good deal, right? To me as an employee, I'm like, oh, well, I would have shelled out 1,200 bucks, but I'll end up paying about 400 in taxes. Hey, I'll take that. I'm 800, I'm 800 bucks net ahead, right? So that's not a bad deal. You just have to be aware and eyes wide open of here's what this means if you're doing a fringe benefit that's taxable. The green flags or fringe benefits, and these are some examples. Um, if you say, hey, look, we're going to offer these benefits, well, health and medical accounts that are tied to expense reimbursement for medical costs, education costs, like, hey, you're going to college, we're going to pay for up to, you can actually pay up to $5,250 a year. I think is the limit, might be 55.50, but I think it's 52.50. I don't look these things up. I always don't memorize. I always look these things up. Um, Childcare in certain circumstances provided by the employer, and then obviously retirement accounts. So these are some of the common kind of fringe benefits where, hey, if I give you that $5,000 for an HSA account, right, health savings account, that's tax free. That's, you get that clean $5,000 cleanly goes to you as the employee, and cleanly I get to deduct as an employer. I don't have to incur any Medicare, Social Security, and Medicare costs. So you can see where fringe benefits and the accountable plan can intertwine. So let's distinguish some of the similarities and differences, right? There's that Venn diagram, right? Accountable plans provides reimbursements of expenses to the employee, whereas fringe benefits provide the perks to the employee. And for it to be tax-free and deductible, there's a high documentation requirement. So our buddy Jeff, let's bring him back, right? He has his consulting business, but his primary business is where is his home. His primary home is where he does all of his management tasks, and that's his home office, right? So he drives using his business vehicle or using a vehicle that he uses exclusively for business to meet with his, management and employees in the office twice a week, and then he's driving all around to the different dealerships where he does the training. So what can he deduct? Well, in his case, we have home office where we've got fringe benefit. So the company can say, hey, we're gonna buy, hey, he needs equipment or furniture for the home office. So we're gonna buy that. And then, if he ever wants to, every 2 or 3 years we buy new, and that home office equipment gets commandeered by his spouse to be put into a different part of the home or something like that, right? So that's an example of a fringe benefit that of tangible, something tangibly good, a good. The accountable plan, under the accountable plan is where we would reimburse Jeff for his home office expenses, right? And so in his case, that's about 8 grand a year, and that's again not an inconsequential amount. So his vehicle that he uses for exclusively for business under the accountable plan, we're going to deduct and say, hey, mileage from home office to the dealerships and other business activities, right? So that ends up being, and that's a little low on the example. I wanted to keep the number simple, but let's say $5,000. So with Jeff, we're able to say, hey, between all the fringe benefits and the accountable plan, that's a $15,000 deduction, a little over $1,000 a month that's going to Jeff that we're able to say, hey, this is tax free to you, but at the same time, a tax write-off for the company. So in the workbook at this juncture is where you would stop and say, okay, here are other examples of how the company can reimburse you for things and legitimately that what we might call lifestyle shifting. And so how would you craft your accountable plan? So, moving on to strategic use, like let's take a look at how do we use an accountable plan and fringe benefits strategically. Well, accountable plan is tax-free reimbursements, whereas fringe benefits are tax-free perks. So, let's take a look at what some of those strategies are that we can utilize, right? Strategies of home office or percentage of home expenses. Um, that could be also for, the commuting. If you have a home office to job site, we could see in the case of Jeff where we were able to capture almost $1,000, 900 and change on expenses for travel. He was traveling quite a bit, and he was able to capture a delta of almost $600 extra that month. And that's going to vary, right? That's going to be variable. Travel expenses where there's business travel. We have an upcoming webinar that we're working on where we'll deep dive into this. But at the end of the day, travel, we can say, hey, we're going to structure our travel in a way that the travel will be tax deductible, right? And in terms of, hey, we're going to take a short break, maybe over that weekend, we're going to be traveling to a place for business that is somewhat of a destination type place. So we're gonna kind of unplug and take a break. So travel, you can turn some business travel into a tax deductible thing. So pitfalls to avoid, we've hit on this a little bit. Reporting or paying the reimbursements back past a reasonable time, right? If you don't meet the deadlines, you can potentially kiss your deductions goodbye because really the IRS says, hey, no less than 60 days to submit for the reimbursements. So you don't want to have your employees, hey, once a year, even if it's just a solo venture. You don't want to just once a year put out your um, expenses and say, "Hey, reimburse me for the entire year." That doesn't look good in the eyes of the IRS, and that kind of violates their reasonable time requirements. And then the employer, the company needs to reimburse with on a more frequent basis. Again, more frequent is always going to be better. And the risk you run there is if we miss those deadlines and those timelines, those reimbursements can get added back to taxable income for the employee. And then the employee and the employer must both pay the payroll taxes on said expenses. So you gain of tax and you lose savings there. So very important to keep those tied in. As a pro tip, again, more frequently is better. So tie this into your bookkeeping activities at the end of each week, or at minimum at the end of each month, right? Don't end up paying a double tax on your hard-earned money because you procrastinated. Another pitfall is that not having an accountable plan implemented. The switch from sole proprietor to S corp, again, that's a really smart move, but it can be cumbersome because you're learning new habits and best practices, and an accountable plan is a habit that really just must be in place. It must be put into place. But again, a lot of accountants, the happy historians, don't tell their clients about this, right? So without the accountable plan, your business loses out on deductions and savings, and both you, the employee, the employee and employer are ended up paying for those taxes out of your own wages. So you lose deductions. And I know that extra step can be tedious, but being a corporation comes with stepped up responsibilities, with great responsibility. With great power comes great responsibility. Spider-Man, is that what that is? Yeah. So doing that extra work is really mission critical. S corporations often ignore the 2%, greater than 2% owner rule, and that S corps can be tricky when it comes to fringe benefits, right? Because the IRS, if you're a W-2, you're taking a W-2 wage, but you own more than 2% of the company, they view you as just owners, not just employees. Whereas with the C corp, you can be, hey, I'm an owner, but I'm also an employee. And so in certain cases, fringe benefits are, whereas they're non-taxable to rank and file employees, they will be taxable to the employer, especially for Social Security and Medicare tax purposes. So you have to be aware. But again, to deduct that expense, right? If I could deduct something for $1,000 on the company side, and then as an owner of the company, if I'm an S corp owner, maybe that deduction, that $1,000 benefit, I end up paying 30% on, on the taxes on that. That's still a good deal, right? I'm still receiving a benefit greater than the cost. So there's a cost benefit there that is going to help me out. And so that's something to consider and say, hey, taxes suck, but I'm getting leveraging a deduction for my business that could end up helping if you have an S corp and you have a state like California where there's a minimum tax that could help you save money, or like in Texas. Texas is on grocery receipts. Never mind. So bottom line is, if you can help reduce your company in net income as well, that could have some carryover benefit as well on the state side. So you're able to deduct those, but again, you're not able to deduct them and have them considered tax-free. Those should be certain fringe benefits need to be added to your W-2 compensation as an S corporation owner. And again, our playbook workbook provides more detail on that. So reviewing what your benefits are tax-free, and if you're paying through the business, you really need to make sure that you're reporting it properly, and each fringe benefit is treated a little bit differently. So make just doing that due diligence and saying, hey, if we're going to offer this fringe benefit, how does that impact the business, right? How does that impact the business owners? Another pitfall is lack of documentation. So documentations really are your protection. It's giving you that shield, receipts, mileage logs, travel documents, bills, utilities, proof of payment, as well as proof of the bill are really what is needed to create that shield to protect you against the fiery arrows of the IRS, right? And then having a written accountable plan really is critical. So fringe benefit documents, again, if you're doing contributions to plans, or if you're purchasing tangible assets for an employee, you want to have a written plan document. You want to have proof of eligibility, that if you're contributing to a plan or contributing to a reimbursement of an expense, proof of the eligibility of that expense. And then if you're purchasing tangible assets, you want to have proof that it's work related, that there's a bona fide business purpose for that. You need to make sure that the non-discriminatory, that you're not just saying, hey, we're only offering this to certain people, and receipts of purchase and then proof of contribution or reimbursement, right? So if you're thinking about deducting something, always back it up with documentation. So in the workbook, we have a section pitfalls, shoring up your documentation, how to avoid that, right? So here's what we've covered today. We've introduced accountable plan, we've introduced fringe benefits, who is eligible, who this is for, strategic use of these things. There's a lot more information in the workbook because every business is, businesses have a lot of similarities, but every business is unique, and so we want to make sure that we're not broadly saying in a public forum like this that there are fringe benefits will universally apply. Take a look at the workbook and say, okay, how do these things help or apply or not apply to me and my business? Um, the wild thing about all this is that this strategy, fringe benefits and accountable plan, is only one of dozens of tax strategies. The IRS doesn't teach you how to use the tax code to your advantage. Again, most people say, my CPA's got me. So putting their head in the sand and saying, I'll deal with this later. But most CPAs are those happy historians, right? They're not proactively helping you put anything beyond the right numbers in the right boxes. And so today we helped flip the script on that to share this strategy of accountable plan and fringe benefits. And it's a secret that shouldn't be a secret, again, is that this is only one of dozens of tax strategies. And the missing element is that you've been stuck playing defense against the IRS and the greedy tax code only because nobody has ever shown you how to play offense. Today we showed you a system with the clear edge framework. And again, if I could wave that magic wand, I absolutely would. But that's why we created that workbook. And proactivity is really the key to creating systems. So with that, I hope that gives you more knowledge and power than you had before. We're gonna kind of cut it off at this juncture and say thank you for attending. Next week, we're gonna host the webinar on a different platform other than Zoom. See if we can resolve the chat disabled issue. So keep your eyes peeled for a email from us saying, "Hey, go here instead of there," and then we'll be sharing more information next week. We're working on a one big beautiful bill, the most recent tax law changes, as an update on the one big beautiful bill and how that impacts business owners. So, with that, I'm going to bid you all adios and thank you so much for attending today. If you found this helpful, you can watch the replay in the school community, and we invite you to check that out there along with the workbook. So, thank you so much, and bye for now.